Welcome back to the channel. This video is going to be focusing on time frames and treating trading like a business. So in trading, there's so many ways to approach a chart. Each person truly has the own ability to perceive the chart and what the market's giving you, the data points, independently. So there's going to be many thoughts that each person has. And truly, the best way to analyze a chart is learning how to grab information and listening to your own analysis. When you listen to other people, that's when trouble will come. So put in the time and have expectations. Plan. So how long would you like to be in the stock market, first of all? Do you want to hold the trade from a day to a week? That would be considered a swing trade. Anywhere from a week longer, a week to a month, it's still a swing trade, but more of an intermediate swing trade. And then anything above a month to a year to 10 years, you're getting into the long-term investing time frame. But number one, you got to grab your time frame. So understand and don't get into the market without planning. Once you have that plan, okay, now there's less questions. You're getting somewhere. You could go even further into your analysis and start dealing with data and the price and the volume and the fundamentals. So screen time is a subconscious educator. When you're scrolling through charts continuously, you're going to start slowly, subconsciously absorbing all this information. And some of it you may hear a lot over and over in YouTube videos. Like for me, I love pivots, clean price action, clean ranges where the charts, you have a monster run on huge volume, and then what happens? We start to consolidate. We form a little pivot on lower volume. So you get the monster run up, huge volume, and then you get a consolidation of volume contraction while the price action is also contracting, and then you get another explosion, a leg higher on more volume, confirming the move. That's something that really gets me excited in my swing trading. That is the basis of how I enter a trade. I wait for the pivot to form and get that volume confirmation, have an on-time entry due to being prepared, scrolling through charts, etc. So understand how long you want to be in a trade. Understand your risk from your entry point. I love to use the trend line. The trend line, you can measure the percentage from your entry, from the pivot, from the low, from the high, from the open, etc. There's so many ways to utilize that percentage move. So really getting a grab at the timing of the market, and short-term trading, it might work for you, might not. Mid-term trading, it might work. So each person really has their own preferences. We're all different. We all have different personalities. So be creative. And the market's going to be this tough journey because the rewards are so potentially amazing. There's no ceiling on how much money you can make from the stock market. And that is why it's a very hard game. So have a plan, expectations, realistic ones. Understand that time frame. For me, I truly do enjoy all three time frames. And I use this tool called stage analysis to understand what type of stage the overall market is in. So there's a stage 1, a stage 2, 3, and 4. Stage 1 is considered when the market is just going flat and we're kind of stuck in a range and that's all that's happening, not a lot of volume. Stage 2 is when we break out of that consolidation. So you get more volume and now we have an uptrend. And then stage 3 is considered distribution, when that uptrend has now found a top and we're now doing what stage 1 was doing, but after an uptrend. And what happens now, all things that go up must come down. There's always adjustments to that phrase. A funny statistic is 90% of statistics are used improperly. So take that for what you want. But after that stage 3, the stage 4, you wait for the EMAs. I love to use EMAs. They're just an average of price. And once stage 4 begins the downtrend, you have a complete market cycle. So understand, by being objective, look at the monthly chart, then the weekly chart, then the daily chart. You need to have a top-down approach, so you're not trading in a vacuum. If you're looking at the daily, and let's say we want to break out to 100, there's a clean pivot, a nice volume consolidation, and we're ready to break through the 100 level. But on the weekly and the monthly chart, there is a boatload of resistance at the 102, 101 spot. For me, and for most people, if the risk to reward isn't there, we have no business entering the trade. So taking a trade through 100 where there's hidden resistance, had you actually taken the time to go and look at the weekly and the monthly, you would have seen the hidden resistance, understood, okay, my risk to reward isn't valid on this trade, I gotta move on. So you must have a top-down approach and be sure that you're getting the data points that are provided on the longer term time frames. Don't trade in a vacuum. Clean price action can be timed. So these pivots, you wait, and some pivots are going to work, some pivots are not going to work. That's part of the game. Jesse Livermore, one of the famous traders, 80% of your stock market profits are generated through 20% of the year. There's times that you want to be aggressive when the market is in that stage 2 uptrend, providing volume, providing entries, continuation, breakouts are actually following through. And then the other 80% of the year, when markets are chopping, you're in stage 3 or 1, where we're low volume, consolidating. You don't want to be too aggressive. Protect that capital and be ready, be prepared, get that subconscious screen time for when the markets are trending on nice moves and high volume. So lastly, volume should be large, unusual on breakouts. We don't want to be taking trades that are breaking out on low volume. My one critique to that phrase would be, if it's in the first hour of the day, open up 9:30 and you're entering a trade around 10:45, 11, planning to hold it for a few days, anticipating influx of volume throughout the session, then that's okay. But you need to have a tight leash on that stock. If you're anticipating and the volume hasn't came in like you thought it would by the end of the session, then you might want to either raise your stop or even cut the position because what you planned to see didn't occur. So all I ask, if you learned anything, if you enjoy, drop me a like. Please share with someone who might learn from this. My whole purpose is to teach, educate, and help others go through this stock market curve sooner, quicker, less of a struggle than what I had to do. So enjoy your night and please share with people. Thank you.